everyone. Welcome to Viking webinar. We're going to be talking about villas at Sundance, our newest offering. So everyone, I really appreciate you attending tonight. I'm really excited to present this really interesting opportunity in one of our favorite markets, which is in the Texas submarket. And I'm joined by a couple of our good friends here, Chris, our Director of Investor Relations, Judah, our Vice President of Acquisitions. For those of you who don't know me or our company, Viking Capital, my name is Vikram Raya. I'm the CEO and co-founder with my good friend Ravi. We built Viking Capital in 2015 on the promise of, hey, we want to find opportunities that are not available to typical investors in the market. And normally when we as high income earners, my background's in cardiology, and I was a cardiologist for many years, and I really enjoyed it. And as I was practicing, I had income, but I didn't know where to put it outside of the stock market. And the concept of wealth without Wall Street sort of really spoke to me. And I learned about different types of investments out there. And I've learned about real estate, and I always wanted to be part of real estate. And it was really after doing some single family homes and growing a real estate portfolio, I realized that some of the powers of institutional style investing really spoke to not only me, but my colleagues. I had friends that are lawyers, dentists, doctors, entrepreneurs, tech investors, and they were looking for opportunities. And what I found about multifamily real estate, and especially these kind of syndication model and sort of this institutional quality assets, was it provided cash flow, which was very powerful for most folks. It provided tax advantages. Obviously, you could grow your equity. You diversify based on geography, based on asset class, based on different parts of the country, and obviously the appreciation. And so that was sort of the premise of how we built Viking Capital. And we've really grown, steadily over the last almost decade now, and we've grown a really strong team. And we're really excited to share with you a little bit about us and what we're here to talk about, which is villas at Sundance. And so my Vice President of Acquisitions is Judah, and he's been really one of the growth engines of our company. Judah, welcome to the show, man.
Thanks, Vic. I always love these webinars. We get to talk about some of the assets. Our team, which I'm fortunate to head, we identify the properties, we underwrite them, we really stress them, really try and find the diamond in the rough to bring to our investors. And then we bring it through financing and closing, all the underwriting that goes on in between. So excited to be here, excited to share some of the work we've been doing with all people joining us in the webinar tonight.
And then I'll take it over to Chris. Chris Parrinello is our Director of Investor Relations. He comes from the beautiful state of Florida. Chris, tell us a little bit how you work with our investors and some of the impact you've been having on our company.
Yeah, thanks, Vikram. I think what sets Viking apart is we really want to help everyone understand how these deals work. So you'll notice as you get to talk to me, and so a lot of you, I recognize your names. We'll go through the underwriting. We'll have a team of folks, Amir, Amber, Hayden, that you'll get a chance to talk to all of them. And we really come together to make sure that everyone understands what they're investing in and sees the potential.
Absolutely. Next slide. All right. So as I mentioned, I'm a trained cardiologist, practiced for many years at Georgetown is where I got trained at. And I really loved medicine. It was amazing. And as I started exploring, interest outside of medicine, real estate really spoke to me. And, I've started several other companies, but really one of my passions is real estate. And we've really grown from really a small regional player where our first assets were in Atlanta. We've really grown Viking to become more of a national player where we're in almost like, I think, 7 or 8 submarkets all over the country. We have about $830 million of assets. We've raised over close to $300 million of private equity. And, we've been recognized as Inc. 5000 fastest growing company. We've been on the Forbes list on the Business Council. We've been recognized by the United States Congress. We've spoken at CNN. So we've got some credibility and some momentum, and we're really excited to partner with our new investors that are coming in today, as well as really want to honor and respect and cherish the investors that have been with us for a while. So let's go to the next slide. So our team is built to really create the high touch, high quality experience for our investors, but still create the institutional quality results and the focus. And so we have acquisitions, you've met, our asset manager, we have our marketing, we have our investor relations, we have our finance team, we have our asset management team. So it's a really robust team. And I'll quickly speak about our performance. During this volatility that we've been experiencing for the last 2 years, from essentially assets that were bought between 2021 and 2022, there's a lot of turmoil, to be honest with you, in the market. And I would be not truthful if I said, hey, everything's a smooth sailing. There's been challenges. but we really pride ourselves in one of the main principles of that we built Viking Capital on. As physicians, we're wary of risk, and we want to protect against that. And as a cardiologist, I always joke that I like to stress test everything. And so capital preservation is really important to us. And we're really proud to say we've never lost a single investor dollar, and we've never made a single capital call. So we take pride in that, and really want to talk about also the upside. So 26 properties acquired, about $30 million of real estate, and we've been able to exit 9 deals and give our return to our investors about a 24% average annual return. We have investors all over the country, from Hawaii to Alaska to Florida to California to everywhere, and covering 98% of the United States. And actually, I was in Salt Lake City recently to meet with an investor in Utah. So we're hoping to get this as close to 100% as possible. And I'm going to hand it over to Judah, and he's going to talk briefly about demand, and then we'll go ahead and talk about the actual deal right after that.
Yeah, thanks, Vic. Definitely worth taking a moment to look at what's driving our entire thesis. Why are we multifamily, and why are we still in multifamily, and why do we want to be in multifamily for the foreseeable future? Great take here, great chart presented by the Wall Street Journal. Buying versus renting, right? We're in rental apartments. The tougher it is to buy a house, buying a house is very expensive right now, the more likely people are to rent. There's still a housing shortage. Rates are still very high. No one wants to move and give up their old mortgage. So the comparison, the discount to renting versus what you'd pay in a monthly mortgage to renting has never been wider, making a much better value option for people to rent our apartments. Now, who is driving the market? Okay, we understand renting is better than buying this time, but who is doing this renting? So this is a great chart right here. It gives you a sense of kind of the ages across the spectrum and who is renting. That purple area of who is renting is wider than it ever has been. You still have people, in college, post-college, but now people are getting married. They're still renting. People are moving back in with their parents. People are getting married. They're pushing off their first home purchase. Instead of buying that in their early 20s, they're buying in 30s or 40s. So you're widening the array of people who are renting, and more people than ever are renting properties, renting apartments. So we talked about what to do, rent, who is renting. Now, when is the time to be in this market? So you've all seen probably the news on the Fed funds rate and the Treasury. Rates have been going up, which is what's made it so difficult to buy. The name of the game in real estate is buy low, sell high. Right now, we're seeing values for multifamily properties at an all-time low because rates are an all-time high over the last 20 years. As rates come down, they come down, and you see by these graphs, whether you're looking at the fund rate, the Treasury rate, 30-year mortgage, that's when people will be able to borrow more and pay more for these properties in the future. So we're looking to buy right now at one of the cyclical all-time lows. And then exit. Okay, now we buy now. Well, we look to hold properties for 5 years. You'll often see in our charts a 5-year estimated return, because that's how we look to hold properties for. Right now, Fed fund rate still upper fives. I listed the Fed dot plot, where based on the different Feds are expected to be on interest rates 5 years out. 5 years out and beyond, you're looking at sub 3%, mid to low 2% again. Again, when rates are that low, that's when values go back up. It's proven true over the last 10, 15 years, and we expect to hold true going forward, to buy low and then sell at a higher value.
So I want you guys to put in the chat box, where do you think we are? And so this is like a fun little exercise sometimes we do with our investors, like, where, and many of you guys are millennials and some of you are beyond, but everyone knows emojis. And so if you could think about, these market cycles where there's excitement, euphoria, the top of the market, and then there's a sort of a dip and a crash, and then it's time again to get back in. Where do you think we are? Are you in anxiety? Are you in denial? Are you in fear, panic, anger, depression? Or are you in hope? Where are you? I'm just curious. Let me see what I'm seeing in the chat box, guys. Looks like we have hope, fear, denial, fear, hope. Okay, that's awesome, guys. Yeah, and we can't really predict the bottom. There's no such thing as a bottom, but I can tell you there's indicators where things are starting to recover. Things like such as the bid-ask price. So between the seller wanting to capture a certain pricing and a buyer willing to pay a certain price, normally that's the last year or 2 years that was really, really widespread. That is starting to get closer and closer and closer. The other thing we're starting to see is there's more liquidity in the market. The loans, the leverage is starting to get a little bit better. There's transactional volume slowly is starting to increase. And so all of this tells us that, we're probably closer to this bottom, the depression, hope, anger stage, than we're probably up here, where at the top of the market, right? And as you can see here, this is a point of maximal financial opportunity. And, what's that quote, Chris, that you said that when there's blood on the streets, but no one says the full quote?
Yeah, it's a Baron Rothschild quote, and it's when there's blood in the streets, you should buy. And what people don't usually finish the quote, but it's when there's blood on the streets, especially if it's your own. So like if you've gone through some distress and things are really, you're going through some of that anguish, don't let that fear stop you from maximizing the opportunity. That's like you saw it in 2008. Like the folks, we were meeting with those DLP guys in Best Ever. And they were talking to us and they started their company in 2006. And the amount of pain they went to in 2008 was immense. But they kept on going, and now they have $6 billion under management because they were able to work through that really adverse time and take advantage of what was happening in 2010 to 2015 and beyond.
Let's go to the next slide. And, at some of the real estate conferences we've been attending and sometimes speaking at, the information they say is, that sort of that seminal event, the next market cycle event. And Blackstone coming in, one of the largest, I guess, private equity groups in the world, buying a $10 billion multifamily purchase is really them going on the offensive. What that means to me is at least they are bullish on where multifamily is going. And the fact that they're doing such a big purchase at this timing, it gives us a little bit of excitement that maybe this is the beginning of the next cycle. And so not just this number, but other things, other pieces of data and metrics are giving us reassurance here. Next slide.
And Vic, to stack on that, I think the opportunity is really when the institutions come back and they're all buying properties in multiple, 2, 3 at a time in portfolio buys. That's when you start seeing a lot of the opportunities we're seeing today kind of disappear. That's when people know that they can package their properties together and sell to an institution and maybe get a premium. With them on the sidelines, it's an even more of an opportunity right now.
And within real estate, we've talked about there's multiple flavors, right? When you go to Baskin Robbins, you can get the vanilla, the coconut, the rocky road. Similarly, in real estate, there's so many different things: office, retail, commercial, student housing, RV parks, mobile home parks. And many of you probably have invested in multiple asset classes. I'll tell you why our investment thesis is really based on multifamily. I would say 10, 15 years ago, Judah, I would say office was the number one commercial asset class, but really multifamily has taken that stage. And the reason why is, it's a hedge against inflation. It appreciates over time. This is not a luxury asset. This is a needs-based asset. There's always going to be a demand. There's 5 million housing shortage right now. Year-over-year rent growth in general. They expect rents to go up because it's part of inflation. It's part of how people live. They expect a 3% rent bump normally. There's tons of cash flow. There's profit. There's portfolio diversification. So we're super proud to present our latest offering here, which is Villas at Sundance. This asset is located in the Austin, San Antonio technology corridor, and it's really on fire. It's one of the hottest sort of megaplexes or metropolises that are out there. It's a 252 unit property built in 2012. Looks like a resort. We joke like this is our Santorini here, right? Beautiful lakes, beautiful buildings, relatively new vintage, sort of a core plus property with value add, which is hard to find. And you can see here the attractive location and landscaping, everything. So here's exactly why we love this deal. So this technology corridor has been booming since 2000. The population growth has increased by 60%. The average median income here is between $65,000 in some parts of the county to close to within the 5-mile radius of our asset. It's $85,000. Texas, as we know, it's a business-friendly climate. So what that means is there's business incentives, there's low tax rates, there's minimal regulation. There's a thriving startup culture, especially in Austin and surrounding areas. And there's a ton of accelerators and incubators. And this is a millennial friendly place. And as Judah just clearly laid out, millennials love to rent, right? They're really in that renter population. And the nexus of this 13 county region, it's about 5 different powerful industries. It's technology, it's healthcare, it's life sciences, it's manufacturing, it's education. And Amazon, for example, has thrown its flagpole here because it's one of the largest employers, 5,000 jobs. And if you go to the next slide here, this 2012 A-class asset, institutional quality, 9-foot ceilings. It's right on the interstate, right? And it's equidistant from Austin and San Antonio. The population growth, and then again, we're going to get this property really at a discount. We're getting it at almost $148,000 a door, which is usually unheard of in this area. And so this cost basis makes all the sense for us of why we would like to acquire this asset. Next slide. Some of the interesting information: the cap rate's at a 5%. Occupancy is 93 currently. The DSCR is very attractive. So for those of you who don't know, DSCR is debt service coverage ratio, and what that essentially means is how much income is it to cover debt service. And 1-to-1 means you have just enough income to cover debt, and the higher the number, the more income surplus there is, right? And we look at minimum 1.2, 1.3, but our goal is 1.6 to 1.7. That is very strong. And the whole period we're looking here is 5 years. Next slide. And so these are some of the statistics we talked about. It's really low density, good square footage, almost 1,000 square feet per unit, newer vintage 2012. So what we can do is just do revenue generating improvements. We don't have to do much deferred maintenance because it's such a good looking property. Again, it's the right units mix. We love 2s and 1s. We love the fact that it's 200 to 300 units. 252 units is a sweet spot. And there's parking, there's self-storage, there's bike paths. I mean, it has everything. It's a beautiful look at the clubhouse, and I'm going to let Judah take over here about the investment highlights.
Yeah, sure. There's so much about this deal that caught our attention. There's a lot packed into this slide. I encourage everyone to take another look on the replay when you can pause and read everything. And all the amenities we look for in a property, amenities that will attract the highest quality tenants in the market. It's got a beautiful pool area, which you've seen in some photos, gorgeous clubhouse. It's got storage, it's gated. That lake that you saw in the picture, it's actually belongs to the greater master planned area, but we have almost direct access and benefit to it ourselves with the walking path, beautiful views for all the apartments. So really highly amenitized. In terms of finances, we're getting fixed rate debt here. Again, overall, the market, we're getting good signals on the Fed funds rate and where we can let rate lock at. And we got a great budget here to do some great things to the property. It's built 2012. That means the major items don't have to be done. It was even repainted a year and a half ago. Roofs are still in the life cycle of a roof, new roofs. That allows us to spend our dollars on the ways tenants will most benefit from it and therefore pay the highest rents, both on exteriors and strategic interior renovations, low budget. The theme you'll hear from me is lower risk, in order to really achieve the same outsized returns. And location-wise, smack dab between Austin and San Antonio, access to both MSAs is what is driving the population growth in this area. Everyone wants to be here. Again, 2012 built. One thing that's important is because that means the property was built 12 and a half years ago. It means they broke ground 14 years ago. It means the architects started working on it 15, 16 years ago. Thinking where you were 15, 16 years ago, what you were wearing 15, 16 years ago, styles and attitudes have changed. This is due for a refresh, and we get to really spend fewer dollars to get that impact on rents. 252 units is a great size property, gives you economies of scale immediately, even though we already own in the market. Nice 900 square foot units, plenty of space, which are what tenants look for. And most importantly, given that rents on the property are right now in place at below 1,400, and they're going for about $1,450. That means that there's a delta of rent to be captured as we turn these leases with no expenditure. So that's just equity lying there waiting to be actualized. This is what I love. When I look for properties, if I can find what I'm about to tell you, it's what gets me excited. Some people love the pictures, the pool you just saw, the clubhouse, the amenities, charts and graphs. It's what does it for me. This is the risk reward profile in multifamily real estate. Core, that's your brand new product on Main Street. It's going to be your most expensive property. It's going to give you the lowest returns, but it's got the lowest risk because the nicest property in the whole MSA, nothing much to do with it for you to add value. New development, that's the riskiest. Go back 1 second, I'm sorry. New development, that's the riskiest. You buy a piece of land, if things don't go great, you're stuck with a piece of land, you're not really driving any revenue on it. Don't get me wrong, strategic developer, you can do very well. Just different risk profile. Value add, where you typically see it from us, you go into an older property, it needs a whole bunch of work, there's a really bunch of upside. Core plus is right in between. 15-year-old property where not that much to do to it, maybe you can make a few improvements. And there's a sliver of properties that are overlap of a core plus profile. It's newer, not much to do to it, but because of the opportunity, you can get more value add returns. It's a lower risk, higher return profile. That's what gets me out of my seat. Again, great clubhouse, great stuff here. And now I'll turn it over to Chris, can tell you guys more about the different options you have to invest here.
Thanks, Judah. So at Viking Capital, we have a 3-tiered equity structure. And what that means is we have 3 different classes. There's Class A, Class B, and Reserve. Class A is going to be a focus on cash. So the way that we anticipate Class A working is a 10% preferred return. So we anticipate that going out current. It's not guaranteed. If there isn't enough cash flow, you won't get the full 10% current. However, you're prioritized in front of all the other classes. What you're giving up to get that 10% annualized every month is you're giving up the back end. So the 70-30 profit and the 80-20 profit that Class B and Reserve get, you're not going to participate in. Class B and Reserve still have a preferred return. It's 7% and 8% respectively. And you also get the 70-30 profit share and the 80-20 profit share. The minimum investments for A and B are $50,000, and Reserve class is a much higher minimum, and that's how you're getting those better economics. So here on the left, you have our cap stack. So starting at the bottom, you have the debt, which is $24 million. You have Class A. Notice how Class A is only at $2 million. The Class A is going to be the smallest part of the equity because we have to be able to actually perform on that 10% current. So those that are really interested in cash flow, I suggest you reach out to our team pretty quickly. The last few deals, Class A has filled it very quickly. Class B is going to be the biggest tranche, $13 million. And the reason that Reserve is a little smaller than B is Viking's giving up an extra 10% of its profits in order for you to participate there. So a few large investors usually make up that section. To the right, you have the purchase price, you have the total amount of debt, and you have the total amount of equity. And then underneath, you're going to start to see the return metrics. So Class A with that 10% paid out current is an equity multiple of 1.5. Cash on cash is 10%, and the average annual return is 10%. With Class B, you see the increase in equity multiple by getting that 70-30 split. You also have an average cash on cash at 5.6 and an average annual return of 16 to 20%. Reserve, you can see the difference that extra 10% of profits makes on the back end. You have 1.9 to 2.1 equity multiple, the same cash on cash, and a slightly higher average annual return at 18 to 22%. So this slide is really great at really walking people through what the cash flow is going to look like and what the overall return is going to look like. So let's go back to Class A and that 10% paid current. So annually, you're going to have monthly distributions. So every month you will get 1/12 of $10,000 moving through each of the 5 years. When we get to disposition, you get your return of principal and you're made whole with your $50,000 of return, hence the 1.5x. With Class B and Reserve, you're getting 4% in year one, you're getting 5% in year two, 6% in year three and four, and then 5% in year seven. Now, these are estimates, but we do our best to hit these numbers, and typically we're pretty spot on. The annual distributions are also, this is the annual amount. So you're in monthly distributions, you're getting 1/12 of this each month. And then when we dispose of the property, you're getting the $62,000, which is 70% of the remaining profits, pursuant to your investment size of $100,000, and you're also getting your $100,000 back, showing you a 1.9x equity multiple, which is right in the middle of that range we projected on the previous page. For Reserve, everything is, for the distribution, everything is just 5x. So 20,000, 25,000, and so on. And then the equity split is also a little bit higher, also due to the 80-20 split. So here you're looking at a 2x return, which is also right in the middle of that range we projected. So tax benefits. Most people who are on this webinar have heard of bonus depreciation. And the idea behind bonus depreciation is the IRS created a program in which we could accelerate the depreciation of a property and take a large chunk of it in the first year of putting it in service. So back in 2022, you could take 100% of that bonus depreciation you created. In each year since 2023, it was 80%. This year, it's 60%. It's going to continue to phase out according to the current guidelines. And on the next slide, we're going to kind of talk about what's going on with the government and how they're looking at this. So Congress approved reauthorizing this through 2026. Now, it has gotten stuck in the Senate, and it's gotten highly politicized. So we're unsure if this is going to get approved or if it's going to, fall off and not get approved. However, what you can count on is that this year you can get 60% of the bonus depreciation, and next year it's still going to step down. So the best time to get bonus depreciation, if that's a part of your strategy, is now.
If I had to choose an emoji, I'm hopeful.
Yeah, I agree. So sensitivity analysis. So this is a slide from our broader model. I encourage everyone to book a call with me and someone on my team so we can kind of get through the underwriting in the model. But really what this is showing you is how powerful the cap rate assumptions are. So we know what cap rate we're buying at. What we don't know, what we're prognosticating, is what cap rate are we going to sell at. So you can see on the left, cap rates compressing and expanding by about 10 basis points each line, and what that does to the actual exit price, the IRR, the equity multiple, and the average annual return. So today we're buying this property at a 5 cap. If we were not to see any cap rate compression, you can see the highlighted line is going to show you what the property will be worth based off of the NOI projections that we've made. If you believe in the thesis that interest rates are high and currently cap rates are expanded, which I do, then you would expect if interest rates go down for cap rates to compress. How much they're going to compress to, I'm not sure. But the reason that we put this table in our model and why we present it to you is really what you need to do as the investor is come up with what you think and make sure it aligns with what we think. And if it does, then this is a good opportunity for you. This next slide is the exact same analysis, just done for reserve class.
Okay. Thank you, Chris. Happy to take it back. All right. So mentioned to you earlier that we were very happy with the financing. We're able to get well north of 60% loan to value, creative financing, yet kind of safely leveraged. Again, fixed interest rate, 30 years, a healthy interest-only period in order to ramp up our business plan. So this is a good debt opportunity, good financing to get us moving quickly and effectively on the property. And again, this is now kind of the meat and potatoes. I really encourage, I know Chris mentioned booking a call. Please do. There's so much information in the slide that I am more than happy to share. Tell you all that the increasing NOI, that is where the real opportunity lies. That's where we add value. That's where we increase rents. And that's where we drive the value. You can see here, by increasing NOI, $1 million. And again, that's not appreciation. We're not assuming the value of the property is going to go up. That's actual ways we're saving on expenses and increasing the rents and the revenue on the property. That equates to a near $20 million in revenue. That's where we get the value. That's why this is a value add returns, despite the lower risk profile. It's why we're very excited about this opportunity. As with most of our properties, we're going to rebrand this one to Elevate. We've been able to establish a very successful brand where we do a lot of good for our investors, for the tenants. It's our Elevate brand. And certainly this opportunity fits the mold as well. One thing I wanted, it was on some earlier slides, but I knew I'd mention it here. Great mix of nearly 50-50 of 1 and 2 bedrooms here. We're seeing a very large appetite of some young adults who move out to this area out of downtown Austin because they want lower cost of living. And they actually, the most popular floor plan is actually the larger 1-bedroom floor plan. So I'm glad we have a lot of 1 bedrooms here. But this area is also attracting families, young families, people with roommates, and the increased square footage, the increased room of a 2-bedroom is also very attractive. Having a nice balance diversifies risk. It's something we look for. Here's a good look into the interiors. Just to give you a quick sense, they're beautiful units. These are kind of lit up for the camera. We're going to improve actually the lighting. We're going to put the plank flooring you see on that big picture throughout all the living areas. Right now, there's carpeting in most of the units. And then as this one has been done with this one, a lighter paint scheme, whereas a lot of the units have kind of more a taupe or a brown or a darker gray wall. So a low-cost way to really revitalize the units to the status you see here. Again, more of an example. It's kind of funny that I should mention better lighting when mine all went out, but we really are going to do a great job with these units. State-of-the-art fitness center, again, just gives you a scope as to the amenities on site. It's what attracts the tenants to this property, not just this area, but this property. Yeah, clubhouse is beautiful. Here are some pictures. We will have some time, I don't know if Chris or Nick mentioned it yet, where we will all be on site in the next few weeks or month. If anyone is interested in seeing the property in person with us, you actually might have opportunities on this one. And again, this shows beautifully on camera, even better in person. And it'll give you a good scope and sense of what we're interested in. And this is part of the outdoor pool area. Really kind of looks like a resort. Okay. And I feel we couldn't take enough pictures. They all just look good at this property. It shows very well. Great. Again, good unit mix. Pause here for 1 second. Again, take a quick look at the amenities. You have fully built that island. There is storage outside on the balconies, ceiling fans, great closet space. I mean, tenants, these are everything tenants are looking for, and the units have really everything. A couple things they don't have is what we're going to add at a low cost. Spacious floor plans. Again, call us, talk to us. We'll explain all this to you in more detail, but certainly something that's there's demand for in the market. Okay, now, again, here's what also got us excited. This is one of the, on this chart, it's, again, in the mix. These are just the newer properties. There are some older properties that aren't really comps because tenants aren't looking at this, ours and theirs. Here we are amongst the other properties. We are one of the lowest rents in the area, despite being repainted, despite having better amenities. So rents are low, which is why I mentioned earlier. The new leases are coming in without doing any work, $75 higher. Additionally, there's room to push it with some minor renovations to really kind of meet the top of the market and get the best tenants at the best rents. Kind of just so you see the comps that we just mentioned, sometimes you'll see comps pulled from miles and miles away. They're all pretty tight here. So the information we're giving you is pretty accurate, more accurate than we can usually obtain. And then basis. Again, new builds, you got to buy for 250 plus maybe 300 a door. The similarly vintage properties, so between 2010 and 2017, that have traded in the last few years have traded on average 187 a door. Now we're getting almost 40,000 less per door, just given the timing of the market, than they sold for even in the last year or two. And I'm not talking about the height of the market 2 years ago. I'm talking about in the last 18 months. So we're really getting a nice opportunity, a nice price per door. Again, the name of the game ultimately is buy low and sell high. We're very excited about the basis, our entry point here, and excited to see how high this really could go.
Thank you, Judah. Really appreciate it. Guys, I want to really focus on New Braunfels, the actual submarket. We'll focus on Austin, and we'll discuss a little bit of San Antonio as well. And so this whole corridor is really the demographics are astounding. The employers are astounding. A lot of the growth drivers. So I'll start with the location overview. 5-mile radius, $83,000 income. And then another powerful statistic I like to show is future job growth by 2027 is 47, close to 47%. It's astounding. There's going to be a shortage of units because so many people are moving into this area. I mean, that's an unheard of job growth. White collar employment, 78%. So these people are affluent. They have the money. They like to rent nice places. And so not only will they rent, but they don't mind paying premiums for upgrades. Some of the statistics on New Braunfels, we've talked about the $700 million impact, just this local municipality. It's called one of the best places to live by Money Magazine, increasing job growth 1.7% year over year, record-breaking 32% rent growth in 2023 without an increase in unemployment. We've discussed this demographics next. So here's, again, why this is a favorable apartment market. Number one, the tourism. There's so many reasons to visit this whole corridor between New Braunfels to Austin to San Antonio. I mean, between the sports, between all the college teams, the professional teams, you got the South by Southwest concerts. I mean, there's so many things that are happening here. The tech conferences, a lot of movement into this area. Strong occupancy. New Braunfels actually has one of the highest submarket occupancies. There are amazing amenities nearby, big box retail, premium outlet malls. If you guys joined us on our recent deal before this one in Atlanta, it was right across the street from a premium outlet mall. I don't know what's about Viking and outlet malls, but we're doing this, and we have there's so many retailers here that are really nice. Next, there's as I do research for all these deals and presentations, I always learn something new. But one of the world's largest water parks, average income or million economic impact per year is 261 million. So Schlitterbahn is located right in New Braunfels. Again, an aerial view of our asset, a beautiful property located among affluent housing, and it's essentially equidistant from Austin and San Antonio, and not too far from Houston. So the reason why we call Austin, San Antonio this megaplex, which is a new term they're trying to use, is because the corridor currently has about 7 million population, and they expect it to boom to about 9 million. And Elon has considered his home Austin now, and he's moved most of his companies here. And he's planning to build a transportation tunnel between those two using the technology from his boring company. Austin is considered the Silicon Hills, the number one best place to start business, the number one tech town since 2020, the number two growth in working age population, and the number one city for college graduates. Again, a great town for education, great town for graduates. The hyper growth, just to put in perspective, Austin has seen more than 5 times the nation's population growth. And the majority of that population growth is right in the renter age group that we've talked about at the beginning of the slide. And the median home price has increased by more than $100,000, not like many years ago, but this is since 2019, 4 years ago, 4 or 5 years ago. So it is really difficult to afford a home. And so there is that as long as that gap exists, there's going to be a tremendous amount of rental demand. In terms of doing the research between these two economic hubs, all these companies sort of stand out, right? Amazon has about 10,000 people in this subregion. Apple, 7,000. Tesla, 32,000. Dell, 13,000. Oracle, 130,000. Google, 1,500. And the list goes on. USAA, 20,000 people. So employment, technology, commerce, business, all here. And one of the biggest industries, as we know in Austin, is the tech industry. And you can see that because of the tenants who have more than 150,000 square feet of office space, it's mostly tech based. Why do people want to move here? One is the no imposed payroll tax and no state or corporate income tax. So Texas/Austin and this corridor are very business friendly. So something called the $1 billion club. So these are all companies that have hit a certain revenue cap, and there's 13 of them in general, and together they make this almost $5 trillion of economic impact, starting from companies that like Apple and Tesla to things you wouldn't be surprised, like Bumble, Tito's vodka, and all these other companies. The Magnificent Seven, as you know, are essentially the drivers of the S&P 500. These seven stocks have really driven the U.S. stock market to great heights. And all of them have a presence in this corridor and in the Austin area. And they have a total valuation of 13 trillion. Sundar Pichai from Google, Elon from Tesla, and Mark Zuckerberg have all moved major operations to this Austin area. Within about, I would say it's less than probably a 30 to 40-minute drive from our facility, from our asset, is the Tesla Giga Texas factory, a $2 billion economic impact. And they're planning to build the next Giga Texas factory. It's going to be in Kyle, Texas, and it'll be only like, I don't know, about 10, 15 minutes away from our asset. And so really it's exploding in terms of growth. And the Cybertruck facility being produced in Austin, it's the only place in the country where they're producing that. And we know Elon has moved many of his companies here, almost Neuralink, Boring, XAI, SpaceX has a presence, obviously Tesla. SpaceX in South Texas has a new starbase they're planning to build or nearby, and it's projected to have 10,000 jobs. Apple is spending $240 million to expand its Austin, Texas campus, and that's expected to bring in another 12,000 jobs. Google has this beautiful sort of Burj Al Arab kind of building in downtown Austin, 10,000 jobs. Tiger Woods has combined to do sort of a spa-like concept as well as a sort of a Top Golf-like concept as well. Cybersecurity is a big industry in Austin and brings close to $35 million of revenue to the area. I mentioned South by Southwest. It is one of the largest festivals in the world. It's a combination of film, music, technology, design, and it's growing year after year. And the economic impact is $365 million. And so all the Airbnbs sell out. A lot of people stay for the whole month or 2 months. And so you're going to have short-term rentals. You're going to have overall a compression in demand in housing. The higher education system at Texas is very robust. You got University of Texas, Baylor, University of Houston, Rice, Texas Tech. And on the next slide, you'll see even just the sports itself have a huge impact. Texas home games, $63 million of revenue per home game. And it's per year, $728 million of economic impact. San Antonio, again, another very powerful economic driver. All the attractions in San Antonio from tourism, $19 billion of economic impact with 10% year-over-year growth. The San Antonio Spurs, which are the professional NBA team in San Antonio, have a $4 billion economic impact, and they just landed probably a once-in-a-generation player in Wemby who is expected to really drive up even more ticket sales, revenue, and impact in the region. We've talked about all the attractions. And construction company JCB plans to do a $270 million manufacturing plant and additional creation of jobs. And there's a huge mega region hospital breaking ground in San Antonio, $450 million, really going to expand the healthcare, UT healthcare system there. And so that leaves me with, before I talk about villas, I want to talk about a case study we did at Viking, where our deal that we bought, I think in 2019, I want to say, it's called Reserve at Walnut Creek. It was a 284 unit asset that was in Austin, and we bought it for $36 million. And in just 39 months, we ended up selling it for a large profit. We had a 2.14x multiple and an IRR of 28%. And so that, plus all the things I've presented to you, is why we're so bullish on Austin and San Antonio and this whole corridor. And so as a recap, this is a 2012 vintage property, 93% occupied, 18 to 24% average annual return with a 2x multiple projected. And we'd love for you guys to get in. I think this is going to really fill up quick. It's hard to find these kind of quality assets that actually make financial sense. And so we're really excited to share this with you all. We have multiple ways for you to contact us. We got the QR code, we got the website, email, and we're trying to be cool with the text Sundance, I guess, at a phone number. So love for you guys to really jump on the phone with us, talk to the investor relations team. And even if this deal doesn't make sense, I want you to get educated about opportunities in general, and really go deeper, get all your questions answered. Because I know I saw on the text, a lot of chat questions out there. So we want to answer all your questions. And I think the best way is to just jump on a call with our team. So guys, Chris, thanks again. Any last words for our investors?
No, just reiterating, I saw Amir put a link in the chat to book a call. Give us a call. Let's chat more about the deal. I'll be out there May 4th and 5th. If anyone wants to come to the property, do a little tour with me, grab some lunch, reach out. Love to meet with you.
Awesome, guys. Well, thank you so much. I really appreciate all of you joining us. We have a great evening, and we'll talk to you guys soon.